How would you like to own a boring old CD, but this one beats the returns of the stock market? Well, get ready, my friends, and I'll tell you all about it right now. I'm Bryan Ellis. This is episode number 111.
You're listening to Self-Directed Investor Radio, America's only podcast exclusively for affluent, self-directed investors, where each day of the week you receive innovative investment strategy and deadly accurate market analysis that's untainted by Wall Street and unblemished by government propaganda, all in 7 minutes or less. Coming to you now from iTunes, Stitcher, and SDIRadio.com, here's your host, Bryan Ellis.
Hello, SDI Nation. Welcome to the podcast of record for smart individual investors like you. I didn't get to be with you on Friday, and I really missed that, but boy, did I have a great time with some of your colleagues and fellow listeners at our Passive Property Flipping Summit. That event was for affluent investors seeking to deploy their capital into passive real estate flipping opportunities, and it was just an extraordinary experience. The event filled up many weeks ahead of time, and it was just truly wonderful to actually meet so many of you face to face. If you were there, thank you so much for joining us. My friends, I've got some great info to share, and I'll get to that in about 30 seconds. But first, let me say thank you for listening. This podcast is only about 6 months old, and it's already a major force to be reckoned with because of you. It's astounding how many other shows feel the need to respond to what I say here, because what I teach you is completely counter to the advice given by others who have a conflict of interest. And now there are even a number of shows that are directly ripping off the material I share with you here every day. Yes, my friends, what you're hearing right now is show prep for the other shows you listen to. You know what they say, imitation is the sincerest form of flattery, until the cease and desist letter, of course. But seriously, we're doing so well because of you, and I'm so very grateful to you. Nobody would care about what I have to say if you didn't care about what I have to say, and so really, you are the hero, the person of influence in this situation, and I'm so grateful to you. So I'm going to give you some great value yet again today. Here we go. It would be great if there was a bank that would issue a CD that could equal or even beat the long-term average of the stock market. Well, my friends, such a CD does not exist, as you know, but something that's better actually does exist. And before I tell you about it, let's determine what is actually the long-term return of the stock market. What would you guess? A lot of people think it's 10 or 12%. What do you think? Well, my friends, let's look at the actual numbers, shall we? We'll use a period of 80 years because that's the average lifespan of an American citizen. And over the last 80 years, the compounded annual growth rate for both the Dow Jones Industrial Average and the S&P 500 has been in the 6% range. Surprising, isn't it? Much lower than you guessed, no doubt, but the news is worse than that. Around 6% is what the market has averaged. The results for the typical investor in stocks has been far worse. There's a fascinating study published every year called Dalbar's Qualitative Analysis of Investor Behavior. Sounds like a great read, doesn't it? Well, there is one particular piece of information in it that you must pay attention to. The average investor in stocks does not achieve a 6% rate of return. Far from it. According to Dalbar, the average 30-year annualized rate of return is a whopping 1.9%. Yep, you heard that right, 1.9%. How could that be? The painful truth is that you and I aren't very good at stock picking or at timing. Remember, that magical 6% number is based on the assumption you put your money in 80 years ago and that you left it there the entire time and never touched it. But is that how it really works? No, of course not. Folks, do you remember back as recently as 2008, a year when there were 3 separate days when the entire market fell by about 9%? It was a bloodbath. Or do you remember back to Black Monday, October 19th, 1987, when the entire market fell by more than 20% in one day? The ugly reality is most investors revert to their baser instincts of survival mode when such things happen. That's the nature of the stock market. It encourages emotion-based decisions which lead to buying high and selling low. And that, my dear listeners, is why even though the long-term average for the market is about 6%, the average for people like you who invest in the stock market is less than a third of that at 1.9%. And if your results have been better than that and you think you don't need to pay attention to what I'm saying, listen to this. My friends, there's a concept in statistics and finance called reversion to the mean. This means that anything you're measuring tends to revert to its long-term average over time. If right now you're below average, it's likely your results will rise. If right now you're performing above the average, it's likely your results will revert to the mean. What's the answer? Let's invest in assets that have a higher average. How about, say, 7%? That way, we beat the stock market and the average investor. So where can you get such a result? It's easy. Don't look to Wall Street, look to Main Street. Imagine a local guy named Joe. Joe found a piece of real estate he can buy way below its value. I mean way below its value, about half. Problem is, he doesn't have all the money he needs. This is an opportunity for you to get a slam dunk investment. Here's how. You make a loan to Joe. You lend him money at 7% so he can do this deal. And so that it's easy for him to make payments, you only require him to pay you interest only every month. Joe loves this. He's got a really low payment, and now he can do his deal, but the reason this deal is safe for you is this. You only lend Joe about half of the value of that property. If the property's worth $100,000, you lend him $50,000. If it's worth $300,000, you lend him $150,000. Whatever the value, you lend half. And then there's one other thing. If Joe doesn't keep up his payments, you get to take that house and sell it. And the reality is, you'll likely make a whole lot more money from doing that if you have to. In other words, you have a great plan A. You get to collect 7% interest. And you have a plan B where you can make far more than that if for any reason plan A doesn't work out. But you know what? Joe's not going to miss those payments because this house is such a smoking deal that he wants the profit that's built into it. And thus, you get paid 7% interest guaranteed every single month. No volatility, no complication, no trouble. It's just simple. It's safe. It's strong. Now, you probably don't want to do this with all of your portfolio, but folks, most people wisely consider about 1/3 to 2/3 of their portfolio as the conservative portion, the part where they just can't afford to lose that money. You'll certainly want to really optimize the other 1/3 for high returns, but for that core of your portfolio, the part that matters the most to your financial future, isn't it appealing to think you could beat the stock market and have no volatility and virtually no risk for your money? It's like a really awesome certificate of deposit, only the rate's much higher and it just makes sense to you why it works. But the big problem for you is finding somebody like Joe who wants to borrow money under those terms. My friends, I can help you with that. Actually, I can make that problem go away entirely. It becomes a totally turnkey opportunity for you. Want to learn more? Join me for a special webinar this week for Self-Directed Investor Radio listeners only. I'll tell you more about the strategy, including why it's so incredibly safe and predictable, along with very profitable. And further, I'll show you how to get those results in a totally turnkey manner, so you never even need to understand how to find somebody like Joe, nor do you need to evaluate real estate or any of that stuff. You just get to make incredibly safe loans at a 7% interest rate and forget about everything else. To get a link where you can register for this premium webinar at no cost, just text the word RESERVE to 33444. But there is a limited number of free passes available, and to get one, just text the word RESERVE to 33444. My friends, invest wisely today and live well forever.
Thank you for listening to Self-Directed Investor Radio with Bryan Ellis. Don't miss a single episode. Be sure to subscribe to Self-Directed Investor Radio right now on iTunes, on Stitcher, and at SDIRadio.com. Your feedback is always welcomed via email at feedback@SDIRadio.com. This show is for entertainment purposes only and is not intended as legal or professional advice for your situation. Content is the property of the Self-Directed Investor Society.